to another class in continuation with measurement of national income. We talked about the three methods. Now we will take up the first method, and that is known as the value added method or the product method. So in this we have a few steps that if you use them and if you learn them up properly, you will be able to solve any numerical. So initially, first of all, we calculate what is value of output. First we will see what do you mean by value of output. Simply put, it means whatever production has taken place into prices. So that comes up to what is known as value of output always is at market price, and it has an element of depreciation too in it. So it comes as gross value of output. So first of all we will do that, and then we'll go on with that is the first step. First calculate that, or if you another way the value of output is calculated, that is by what is known as sales plus change in stock, or if you have stocks in the beginning and the end, the closing minus opening, that is change in stock, or just the stock which is available. So it's very interesting. First, in this step 1, we have to first calculate the value of output, and from there we will minus intermediate consumption. That will be step 2. So in the step 1, what we do is we will estimate the value of output produced by each firm in all the sectors of the economy during a year. That is the first step that we take in measuring national income. So what is this? So what is value of output? What does it mean? It is the market value of goods and services produced by a firm during an accounting year. So once again, it is the market value of goods and services produced by a firm during an accounting year. So how do you calculate value of output? It is output produced in units into market price. So this is one, that is simply if there is no stock line, then you can just find out what is value of output just by output produced in units into market price. But often we do have some stocks available, some unsold stock. So if based on that, we have two ways again to calculate value of output produced. We will take in, suppose if a firm had no initial unsold stock in the beginning of the year, so then in that case value of output produced is equal to sales plus the value of unsold stock. Okay, so it will be like sales is equal to output sold in units into market price, and sales is equal to sale of goods and services to domestic buyers plus exports of goods and services. We can do that. That's just a note. If so much is given in the numerical, then we can use that. And second is, if a firm had some unsold stock in the beginning of the year, then value of output is equal to sales plus change in stock. So change in stock is closing stock minus opening stock. So value of output is what? It will be equal to sales plus change in stock. So this is basically what is step 1. In step 1 we do this. Now in step 2, as I've already pointed out, that you have to minus the intermediate consumption. So then you get value added. So value of output minus intermediate consumption will give you value added. So let's talk about the second step. So in the second step, once the value of output is calculated, then you will calculate all the intermediate goods that have been produced or that have been used in the final product. You're going to minus, or you're going to subtract all the value from there. From what? Value of output. So that is step 2, and which is very important. So you can say step 2. So step 2 is calculation of value added, and this is also valued at gross domestic product at, then it becomes gross domestic product at market price. So this is value addition. So value added or value addition is the difference between value of output and intermediate consumption. So this is how you will see, and later on I will explain to you value added with the help of when we are talking about double counting in the next class. I think I'll be doing that. So that is value added. Then you had what is known as step 3, calculation of net domestic product at factor cost. So after you do this, you get gross domestic product at market price. Now this, in step 3, we're going to calculate net domestic product at factor cost. So we have to make this with the help of depreciation, indirect taxes and subsidies. So how do we do it? So NDP-FC will be equal to GDP-MP minus depreciation minus net indirect tax plus subsidies. So when you do this, you get NDP-FC, or the other name for it is domestic income. Now in this, for step 4, let's take step 4. In this, what happens is you're going to take calculation of net national product at factor cost, or the other name for that is national income, NNP-FC. I'm sure you know about this now. So from DP to NP, what will you do? That means domestic product to national product. What happens? Yes, you've got it. You will add up net factor income from abroad. So based on that, you will, this is the only way that you calculate or you measure national income with the help of the product method or the value added method.